Hello mortgage coaches, this is Jacob with support. This video is to show you how to work around a debt consolidation inside of Edge. So as you can see, there's no debt consolidation report just yet in Edge, but I'm going to show you a way to use some of the fields in Edge so that you can actually reflect that debt consolidation and show a reinvestment strategy. So for this one, I'll make it a marketing report. I'm just going to call it debt consolidation. I'm going to say the person does own. Friendly name is pretty important. In this case, since it's a marketing report, my friendly name is kind of the report headline, so I probably don't need this one right now. The next step here, I'm going to do payoff debts, and let's say they got $30,000 in debt. Then I'm going to assign the current property value. Let's say they're at $300. And now it's time to enter the current mortgage details. So let's say they took this mortgage out a couple years back, and when they took it out it was for $250, and they got that at a 4.5% interest rate on a 30-year term. So you can see we've got the remaining balance of $241,389. Now, assuming they've made an additional payment or two, let's round this figure out. I'll change it to $240. And you can see I've got my P&I payment there. The part that's really going to reflect the debts is going to be the next screen. So when I'm entering my monthly escrows, I'm going to pop in my hazard and taxes just like normal. But the difference here is I'm going to use that other field. So the other field I'm going to use for the payment on the debt. So $30,000 worth of debt, let's say they've got a $1,500 payment for that. Now what this is going to do is it's going to increase my total pity payment by that $1,500. Now when I go to show it in the new products, I'm actually going to show the exact same escrows, but I'm not going to include that $1,500 because they're no longer responsible for it. So let's get over there. I'm going to skip the affordability. You really probably don't need to do anything here unless you're going to be working with reinvesting straight back into their savings account, which that could be an option for you, especially if you're doing this for a CPA or a financial planner. But I'll show you a way in the analysis screen that we can use the investment part to do the same thing. So new products. First thing I'm going to do is let's call this one refi rate and term, and this one's just going to be a straight refi, no debt payoff. So I'm going to check the refi switch, and you can see it automatically brings in my 240. Let's see if I can get them a 4% rate of return, 30-year term, not rate of return but interest rate. I'm going to pop in my closing cost details. If you do have templates in here, just use one of those, and I'm going to apply my cost to the loan. And then make sure to enter your escrows again. And because this one is not refinancing the debt, we got to make sure and account for that debt here. So I'm going to add another product. This one is going to be debt consol. Now what I'm going to do is I'm actually just going to copy the other one that I did. So I'll copy the one that's just a rate and term and hit OK. And I'm going to increase the base loan amount by the amount of the payoff. So remember, I have $30,000 that I need to pay off. I'm going to increase this to be $270. And let's say I can get the same rate, that 4%. If it's a cash out, you might actually get a hit. We're going to end up going over 80% here. So I'm actually going to put it at 4.25. Now, one of the most important parts here is that you need to make sure and account for the actual debt payoff so that your cash to close comes out right. If I left it alone just like this, it's going to show a $30,000 cash out, which is technically true. They are cashing out the $30,000. They're using it to pay down that debt. But if we're looking for just the cash to close here, I want to show it as a zero because I want to show them paying the debt down. So what I'm going to do is I'm going to go into the closing cost detail, and I'm going to add a new line item. So I'll add a custom fee. I'm going to call it debt payoff, and then I'm going to make this a prepaid escrow. And the reason for this is I don't want it to factor into the short-term savings area. Remember, the short-term savings compares the total interest, MI, and closing costs except for the prepaids. So those ones, we want it to exclude this one, so we're going to make this a prepaid so it doesn't factor into that equation and lopside our analysis. So now once I've got it in there, I'm just going to input my $30,000. It is a non-APR. I'm tagging it as a prepaid escrow. Obviously we can't add this to the loan amount. That would increase the amount financed by that much, and we don't want to do that. And we're just going to hit apply to loan. Now the last part here is I need to make sure and get rid of this $1,500. They're no longer responsible for this. They probably are going to have MI now, so there's going to be a little bit of a variable here. Obviously, if they're lower and lower LTVs and you can stay out of the MI category, you're going to be better off because you're going to save them a little bit more money. But in this case, I'm going to go ahead and put in my 0.9 variable for conventional, and then I'll leave it at 78% for the cutoff. Now I'm done with the products. Now I've got to figure out what I'm going to do with the savings that I'm showing them. So I'm going to go to my adjust reinvestment strategy grid, and you can see that on the rate and term I'm saving them $121. So let's put that into a new investment vehicle. So let's say that I've talked to my CPA, my financial planner, and they can get me a vehicle with a 2.5% rate of return. So I'm going to indicate that I want my borrower to put that 120.91 straight back into that account. And in 15 years, they'll have 26 grand in that bank account. Now the debt consol, this one's going to be a lot better because obviously we have a lot more money that we can attribute to this. So if I want to, I can actually put it into that same account. So we're looking at kind of an apples to apples approach here, 1235.97. And naturally they're going to have a lot more money in that account at the 15-year point. Now you may want to recommend a combined strategy. Say for instance, you want to take and put $1,000 into that investment account, and you want to take the other $235.97 and put it towards paying down the mortgage. And you can see that by diverting just that little chunk, they've now reduced their freedom point to 22 1/3 years. We've shaved them 4 years off what they currently had, and at the 15-year mark they still got over $200,000 in the bank, so this is definitely going to be a good strategy for them. Now let's get to the presentation. I want to show you exactly why I use that prepaid escrow line. Alright, so as you can see here, my cash to close on the rate and term is $38.75. My cash to close on the cash out is also $38.75. That's how I know I've done it correctly, because I'm getting a direct payoff of that liability debt. So when you go into the more info sections here, we can see what's going on. We're going to look at the closing costs, and you can see that we've got $30,360 in the prepaid items. And the reason for this, of course, is we have $30,000 in debt payoff and then $360 in prepaid escrows. Now if we drill down into the fee detail, you can see where that debt payoff comes in. That's that $30,000 for the borrower, and because we made it a prepaid escrow, you can see that our debt consol, we're still going to be saving them money by going one of these other options in terms of the interest they're paying on the mortgages. Remember, this won't show the interest that they're saving on those debts that they paid off. However, had we not made this a prepaid escrow, you'd see these would be closer to $50,000 differences. So it would basically factor in that $30,000 as a closing cost, and we don't want that to happen. So that's pretty much it. This is the debt consol in a nutshell. I think probably for this one I would show them net worth over time. So I'm going to go back into Edge to my analysis screen, and I'm going to adjust this to show net worth and hit the right arrow. And we should see our preview populate in just a moment. It'll change from principal paid, and there you go. You can see the net worth on the debt consolidation, $568,000 versus $338 on the rate and term. Now remember, the debt consolidation, or the net worth, is a combination of their total equity plus the liquid assets that you developed for them over time. So in these cases, they've got no liquid assets. We're just showing them, here's your rate and term. You're increasing your equity because you're diverting that cost savings a month, that 121, straight back into the principal. But in this case, we're doing both. We're taking $235 and we're putting it back into principal, and we're taking another $1,000 and putting it straight back into that investment account so they can develop wealth. So this is really going to be the crux of your conversation with your CPAs and financial partners. This here, it's kind of going to be a wash. I mean, if you look at it, you've got an $18,000 difference in interest and MI paid on this new loan, and that's just because we're taking out $30,000 more than we were before. But when we really look at it, the difference here is staggering. And if you want to line them up, change the net worth to be 5 years, so it's at the same point as this. I'll show you what that looks like. Or change the short term to be longer. Either one's right. Basically, we just want to show the same type of metric. So over the 5-year point, we've got an $18,000 disparity in how much interest you're going to pay. But we have a $50,000 difference in the net worth. So you're looking at a net $32,000 gain between these two items over the 5-year period of time. And it just gets greater over time because we've got a great rate of return on this investment account. But if you have any questions on this, feel free to contact us over at support@mortgagecoach.com, and we'd be happy to help. Thank you, and have a wonderful day.